Bring it back to politics. Mamdani.
Motherfucker.
Are you guys leaving New York, or what's the deal?
I mean, to his credit, like, he ran an incredible campaign with some extremely strong content people behind him that just did an insane job.
We should hire them to make DePIN great again. God damn it.
We just got a big neon EV3 sign that got here yesterday that I'm looking forward to installing next time, so we can all compete now. There we go.
I have a neon Helium sign, actually. I used to have hung up. Might be kind of tough to put it on the wall or something, but limited edition. They don't sell them.
It'd be hilarious if you had like a pollen one.
Connor would have a pollen LED sign.
Have to throw that out.
You're looking at the single biggest pollen deployer like in history.
Connor is?
He's got to be, huh? Hexagon.
Who are number one?
Yeah.
I don't know, man. Max Gold deployed a lot of those routers.
That's it. That's ancient history, though. Santi, how was the Empire pod?
It was good, man.
Was it news based or was it topical?
It was topical. We brought in Pranav, this guy who runs Vanek Digital Fund. Great dude. Talk about macro. Talk about the future of crypto markets. It was good. Mambani, the election?
Mamdani. Yeah, no one can pronounce his name. It's this crazy name.
Motherfucker.
Are you guys leaving New York, or what's the deal?
Yeah, what New Yorkers? Let's hear it.
Dude, this is fucking awful. Like, literally, it's so bad. I don't understand how this is, like, even possible. I mean, I guess I get it. At the end of the day, the city has, like, a really productive underbelly of, candidly, workers that, do a lot of the jobs that are hard to do. And for whatever reason, I think over the last 20 years, just New York has ignored them for whatever reason. I think Mamdani was able to get those workers out in size, and I mean, to his credit, like, he ran an incredible campaign. He stuck to his values. He was kind of as authentic as can be. I mean, look, there's all these claims that he's a bit of an actor. The TLDR is his mom is known in, like, Indian filmmaking circles as, like, being a bit of a puppet master. So it's not crazy that he won to me. He's got, like, a really well-funded campaign with some extremely strong content people behind him that just did an insane job.
We should hire them to make DePIN great again. God damn it!
Honestly,
I know.
yeah.
It all comes down to can you craft a good narrative, and can you capture attention?
It's true.
We were talking about in the pod, like, is the American dream alive and well? We're on a relative basis. I think it still is. I think just people lose perspective, man. It's like this fucking generation's so non-committal, and then it's all trying to optimize. I'm like, what are you talking about? Objectively, across all vectors, your life is better than what it was for prior generations. But you're on the gram, and everyone's entitled to now be a billionaire or a millionaire, and it's like, no, dude, you can still live a pretty good life if you work hard. Just you gotta work hard. People now, from hiring. I mean, I'm going to go this on the record, but, like, I just get a feeling a lot of the candidates are not willing to put in the work, dude. There's a sense of entitlement. There's a sense of, I deserve it. I'm like, no, man, how about working 100 hours a week? And then we can talk about, you making, like, decent amount of money. Like, we were all there. We all worked out. I don't know.
No, I totally agree. It's shortcut culture. I don't know if you know this guy, Sunil Srini, really smart dude, as BD team on at Ritual, and he wrote this, like, amazing piece about how, like, Gen Z is kind of the shortcut generation, and they just want a shortcut for everything. So, like, you look at the biggest healthcare product, it's like shortcut to lose weight. You look at, like, the biggest financial products, it's like shortcut to make money faster. And, like, biggest AI product, shortcut to not think. And it's just like all of these ideas that just, like, make work that people have to do and suffering go to zero are just proliferating like crazy.
The interplay between dopamine and, like, human behavior is something I think that everyone takes for granted, but it's something I'm even thinking about in my own life. Like, whenever I optimize for cheap dopamine, like social media or whatever it is, like, life just goes downhill. That microcosm can just be expanded to, like, salaries, working hours, all these things.
To tie this all back together, I think it's also like a reflection on the election, Mahesh,
Yeah.
of, like, the shortcut generation. Like, what's the shortcut to cheap prices? It's like rent control, except that leads to a lot of other bad problems down the road, right? What's the shortcut to cheaper groceries? City-run grocery stores, until you realize that it runs all the other grocery stores out of business. The first order, like, effect of shortcuts, like, and not thinking about it as a second order effect of, like, everything that spirals out of control. There's a nice way to, like, tie this up, actually. I think that, like, it is just a reflection on, like, society at large of, like, what's the shortcut for me immediately. And eventually we'll have to answer for the long-term second order effects.
Yeah, maybe in happier New York news, Santi, did you run the New York Marathon this past weekend? Or did you skip it this year?
I had the alarm set from 5 in the morning, And then I was like, yeah,
Nah.
maybe not the best idea, dude. And I was like, I went and saw, like, woke up around 11, saw the pro female, pro males, and I was like, fuck. I went back to my hotel room. I was like, I'm gonna go for a run. Man, I ran 10 miles. I'm like, yeah, no, I would have never finished that thing.
He tried to convince me to take his bib. I was like, no, I'm in the middle of marathon training. I'm not at the end of marathon training. This isn't gonna happen.
There are no shortcuts when it comes to marathon training.
There's no shortcuts for that.
There's no shortcuts.
Yeah.
Yeah.
Dude, what is it about being a guy where like you turn 30 and like everyone's just into marathons now? I feel like all my friends are running marathons.
It is like a quarter life, midlife crisis for sure. That like it's very common amongst people.
No, man, I'll tell you why. It's not about the age. It's anyone can go from couch to running a marathon in 2 months. Unlike weight training, unlike weight loss and other
Mahesh,
disciplines.
you got 2 months. You got 2 months.
I was gonna say that's highly
Mahesh,
unlikely.
I'm not saying you run it gracefully or like record time, but you will run that goddamn thing.
I might walk
it. But you can see very big improvements on a week-to-week basis, and that's, again, translating back to a shortcut generation. In a world where people are addicted to dopamine and quick results, running is actually one of the few disciplines that continuously gives you a very big improvement in a very short period of time on a week-to-week basis. And so, dude, that's why running, absent pickleball, is probably the fastest growing category. Because Jason, you tell me. I mean, you quite literally, I haven't met anyone that can't do that unless you're like morbidly obese. But you know.
Yeah, there's probably a category of people that can't do it, but like I think most people could probably do it.
Man, for whatever reason, it's like that's a massive thing in like white people culture. In like Asian Indian culture, it's like it's really not a thing at all. I mean, look, there's all these Americanized Asians, I think, that do it and do it really, really well. But it's like you tell like any of my aunts and uncles in India that like you can go from the couch to a marathon in 2 months. They're like fucking laughing you out of the room
Until they start moving.
if they start moving.
I ran my first one in Lisbon 2 weeks ago.
How'd it go?
3:29:56
Killer.
by 4 seconds. Thank
Killer.
you. Yeah. It was basically like a solid 3-month block of training, kind of like what you guys were saying. And then I had a pretty good cardio base going in, but it was a really cool experience to just do all the training, go over there, do race day. It's first time for all of it. So
I saw that picture of you guys all afterwards. Did Connor run in Birkenstocks? There's this picture of all of them after the marathon, and Connor Ting is like wearing Birkenstocks.
different Connor, but he just took his shoes off after the race. He was beat up.
Speaking of on the political angle, let's talk about DePIN. Yeah, Jason, congrats on announcing the round. Should we just start there because it was a huge deal? I want to cover that. And the thesis for Daylight's always been, look, public infrastructure is failing us. Cities are strained. Public, the government's never been the best allocator of resources, and you're seeing it. The grid is breaking down, and so yeah, congrats on the announcement. Huge deal. But why don't we just start there?
Yeah, we can jump right into it, and appreciate it. I mean, you're absolutely right. If you think about electricity today, the way I summarize it really is like everybody's paying more for less. Power prices have significantly outpaced inflation. I mean, there are markets in the U.S. that have 20% year-over-year electricity price increases. These are incredible price hikes, and that's after years of further price hikes. Electricity that is now 35-40 cents a kilowatt hour is just absurdly expensive. You're paying more and you're getting less. Blackouts are now something like doubly more frequent than they were in 2013. So over the course of a decade, we've doubled the amount of time that the average American spends in a power outage. It's about 8 hours a year for an average American, which doesn't actually sound like a lot, but you forget that the average is not what the worst experience is. And the worst experience is multi-days, if not to weeks. So it is a real problem. And on top of that, it's only going to continue to get worse as AI and compute infrastructure continues to gobble up electricity, as deglobalization and reshoring of industrial manufacturing becomes a larger and larger trend, as robotic armies, as Elon's robotic army and the other guy's robotic army start to take over warehouses, as autonomous vehicles become more and more frequent, and Uber and Tesla start to replace drivers with electric vehicles. All these things have a huge amount of electricity demand, and they change the profile of electricity consumption, which makes electricity even trickier to manage and blackouts even more frequent. And so this is a very, very pressing moment. The electron is the most critical commodity of the 21st century. I mean, there is no ifs, and or buts about it. It's not oil anymore. It's all about the electron and who has access to electrons at scale. China is really kicking the US's ass at building, electron factories, if you will, power plants. And so Daylight is here to present a new kind of capital markets model for scaling distributed energy capacity as an active resource for power grids, which is the cheapest and fastest way to scale new energy capacity on power grids today, while also ensuring that the people that are most exposed to the downsides of all this economic growth, individuals, can both, number one, have cheaper, more reliable power, but also get to participate economically in the upside of what the future of electricity markets look like. And Daylight's the only one kind of building towards that mission.
Can you talk a little bit about, again, bringing it back to politics, because that tends to be like, how do we get to a point where electricity prices go up 20% year over year? Is it some markets are regulated, other are deregulated? Like, just for anyone that's just waking up to this, how do we get to this point?
Well, really, I think the core issue here is, utilities have a business model that is misaligned with delivering power cheaply and reliably. Utilities are the only business in the world that have a basically statutory government-led guaranteed rate of return on infrastructure spend. And so all a utility wants to do is deploy more and more capital into infrastructure, because every dollar they deploy in infrastructure gets a guaranteed 10% rate of return on that infrastructure. So there is kind of this misalignment of incentives, number one. Number two, we have all these increases in electricity demand that we kind of talked about from all these new sources, whether it's AI and compute or it's many of these other things that are increasing the demand for electricity, which increases strain on grids. Because remember, power grids aren't built for averages, they're built for the peak. And if you can't manage the peak, then everything becomes much more expensive because you're building all this excess infrastructure to make sure you hit the peak 1 second of the 1 hour of the one day that peak energy demand is the highest, and all the infrastructure needs to be able to facilitate that peak, not the average. And the last side is like all of our transmission and distribution infrastructure is very, very aged. A huge portion of it. The Society of Electrical Engineers, or some society like that, I forgot, who does like the infrastructure report, put out a report on the state of the U.S. grid, and it was like a D-, because so much, like a majority of the transmission and distribution infrastructure on the grid today is either at useful life or very close to the end of useful life.
Yeah, it's on average like over 25 years old, right? Why do you think this, like, what is stagnated that hasn't allowed, one, the underlying infrastructure to be upgraded, and two, like, why did these systems just languish?
I think it's like the classic NIMBYism story. On top of that, right, is this issue where energy demand growth has been flat for 20 years. So there wasn't really this big incentive to invest in new energy capacity because energy efficiency gains really outpaced energy demand growth. And so we saw electricity demand growth as flat for 20 years. We have an entire generation of utility, ISO, power trading executives that have never seen energy demand or electricity demand increase. And so there just wasn't this incentive there, and there wasn't this prediction of what was to come. And all of a sudden, all of these mega trends, all these super cycles hit at once: robotics, AI, compute workloads, reindustrialization, deglobalization, electric vehicles, and they hit all at once, and as things typically happen in like the history of the world. And now everybody's struggling to figure out, how do we manage this?
And when does the new mobile app come out? You guys teased some screenshots on Twitter that looked very consumer friendly.
Talked to the team on the latest, but I think ship date's supposed to be next week, barring any major issues.
Maybe dovetailing to what the app does. And yeah, there we go. Just curious, Jason, what does this mean for folks that you're serving? Like,
Yeah. So, Daylight builds capital markets to make distributed energy an active grid resource. And that's like kind of a two-sided marketplace, right? There's scaling capital, which we'll do in DeFi through the launch of really a tokenized product built around electricity revenues from funding this underlying infrastructure. And then you need to have people that go out into the world and deploy this infrastructure and host this infrastructure in their homes, their businesses. And so the app really serves that side of the market, where we incentivize people to go out and collect data on their home, discover if their home is a great fit for Daylight subscriptions and hosting Daylight infrastructure, rewarding them for that behavior, educating them on that behavior. And then once they enter into a Daylight subscription, giving them more rewards for their participation and engagement, allowing them to manage their subscription, pay their subscription, allow them to connect all their other energy devices in the home in order to manage those and also contribute data to the platform. It's really kind of the engagement tool that we use to drive originations at scale. And what would be cool is even people that aren't, a good fit for being a host, the app will have more and more features rolling out built around allowing them to build kind of side hustles originating in their local markets, or even just connecting their own energy devices like smart thermostats, electric vehicles, whatever they may have in their home, to contribute that data to the protocol. Because all that data that we're collecting is incredibly valuable for improving the forecasting and measurement and verification models that go into taking a distributed asset fleet and making it operate like a centralized fleet. And so everybody can really be a contributor, whether it's bringing people into the network, hosting infrastructure on their own home, contributing data from their energy devices to reinforce the kind of software value. And so all of that is kind of streamlined through this software experience.
That's interesting because most of the time when it comes to decentralized infrastructure, whether it's a layer 1 blockchain or a DePIN network, everyone talks about distributed nodes, and like there are some rules of engagement when it comes to how fees, priority fees, like basically traffic lanes, if you will, for to make that analogy. What you're saying here is, I think I haven't really heard it as much around this. Yes, it's distributed infrastructure, but there is a centralization kind of body that like routes the resources or maybe the pricing. Can you go a little bit more into that? Because I think that's a pretty interesting kind of construct.
Yeah, it's not centralized in the fact that like there's like a single orchestrator here necessarily, although like the assets themselves and like the pooled capacity will be bid out to energy companies that want access to it. But when you think about a distributed energy fleet, what you need in order for that distributed energy fleet to be useful is software that orchestrates all of this as one giant pool, because what we're attempting to replicate is a large centralized power plant. A large centralized power plant produces electricity, it meters that electricity, it delivers it to the market, and then is paid for delivering that electricity to the market. All these distributed energy resources need to do that as an aggregation. And so what all of our software is doing behind the scenes is taking all this data from people that are participating in hosting our infrastructure, or just providing energy data from other energy devices. Because what we need for every single node connected to the network is a forecast on the consumption profile in the home, based on the weather, based on the time of the year, based on the sunrise and the sunset. We need a forecast on the solar production. We need a forecast on the battery capacity and the available capacity based on, is the homeowner going to use it or are they not going to use it? We need all of this information metered and available, because what it does is it rolls up to one big aggregated level of what do all these distributed nodes, if they are orchestrated together and deliver electricity together, what can they offer the grid at this moment in time, and what can they offer the grid over the next 2, 3, 4 hours?
Going back to that, problem that you're addressing, which is in some markets just saw a huge spike of, pricing. What's the end state? Like in a couple of years' time, you have, in a market like Texas or Northeast, like what would that do to energy prices?
Oh, I mean, I tweeted something out this morning, actually, from Australia, from a Financial Times article on Australia. Australia has 30% penetration in distributed solar on homes in Australia. It's massive. Something like, yeah, I mean, it's like exceptionally large. How many homes? It's almost 40%. It might be closer to 40% than 30%. What's interesting about this is they are now forcing 3 hours of free electricity per day because there's so much distributed solar production. It is literally larger than the entire coal fleet in Australia today. There's so much free electricity production from all these solar systems that electricity is just going to be free in the middle of the day. This is like
Wow.
the energy abundance argument.
That's
where
crazy.
people are getting power cheaper structurally because they are generating and consuming their own electricity on site. And then they're working together to share that electricity throughout the system, almost to the point where power prices start to decline or go to zero because there's so much available capacity hosted by all these distributed nodes in the system. This is what happens when distributed energy really takes over a grid, because again, you can scale it so much faster and somewhat, it's not truly permissionless, but much easier, much faster, and much cheaper than building all these planned centralized power plants. And you start to see these interesting market mechanisms take place.
I'm unfamiliar with Australia, but I assume the government had played a huge role in subsidizing or at least incentivizing people to deploy solar panels. I mean, the price of solar panels has come down dramatically, but still requires some financing, which I think ties into your announcement, which is, there is an element of that. But can you talk a little bit about how Australia got to that point where there's just a lot of solar panels, a lot of capacity in the market?
It's a really interesting case study. The government did do quite a bit of subsidies. They, did kind of, I'm not entirely sure what it is. I'm not going to name whether it was tax credits or feed-in tariffs or a mix of both. I think it might have been a mix of both. But I think the interesting outcome of the initial subsidization in the market is that, unlike the market in the US today, which is very much a push marketing market, like door knockers trying to sell solar, it is a pull market. Solar is an appliance in Australia. people go to not the grocery store, but you can buy solar at Costco, and you can buy your panels and sign up a contractor in your market, and it gets installed. And so the cost of solar in Australia compared to the cost of solar in the US is about 25% of the total cost. I mean, it is literally less than $1 a watt to get solar installed in some cases in Australia. And the average price that homeowners pay in the US today is somewhere around $4 a watt. And that delta is not equipment cost, maybe a little bit because of tariffs in the US, but it's really not equipment costs. It's basically some level of installation costs, and then mostly inefficient customer acquisition and marketing that's just kind of taken over the industry in the US and left a sour taste in people's mouth. And so the big DePIN angle for Daylight is using these incentives to kind of equip a community army to go around and try to turn this into a pull marketing where users are just coming to the platform for incentives and for a better energy product. The energy system is doing some of the marketing for us by power prices increasing, reliability decreasing. And then we truly do believe that tokens can do the rest of the job for us, incentivizing people to come to the platform, incentivizing people to go out and become, effectively small business franchisers of Daylight and scaling Daylight in their local communities, and using tokens to kind of solve that incentive and coordination problem, and then have the capital market side on chain that is providing the capital to cover the costs and make sure we can scale this super efficiently.
Do you think the reliability on the installation and ongoing maintenance will be the same in this manner versus what you had in Australia?
Yeah. I mean, the equipment is largely the same, right? It's the same manufacturers. It's, the installations are very standardized. And so I think in general, I wouldn't expect there to be any major issues on the O&M side across markets.
Maybe not to go too much into the tokenomics, but I would assume some of the rewards are tied to how reliable and how good you are installing it, right? If there's a bad installer, you're probably going to weed them out of the network pretty quickly based on reviews or just, lack of performance. Because you always want to maintain, this crowdfunded approach, but you still, I guess people are not familiar with this, but like even on the telco side, if you were to, like, large telcos rely on a bunch of third parties to actually deploy and maintain cellular towers. Like, so it's really not that different, but yeah, that's interesting.
Yeah, I mean, very standardized QA/QC processes on the installation are very necessary. And that's like one of the things that we do is make sure that installers that are coming on a platform are vetted, and they go through a very comprehensive kind of QA/QC initial process, and then projects go through a randomized QA/QC process as well. Actually, every project has to submit actual pictures of the projects themselves, and then we do random site visits as well. And before the actual final milestone payment is made to the installer.
And where are you guys at on subscriptions? I think you've activated them in some markets, but is there anything you can share on uptake or kind of initial customer reactions to what I think is a pretty good deal from a homeowner's perspective?
We won't share too much just yet, but I mean, it's exciting. And Massachusetts is our big push right now. It's our beachhead. The power prices are incredibly high. So, in some cases, 35 cents a kilowatt hour. So the market is demanding this. Very attractive VPP participation opportunities that allow us to increase yields and capture more margin, and also return a cheaper product to the homeowner. So there'll be some exciting news coming out of Massachusetts pretty soon. From there, we'll be kind of expanding to other states that meet that cross section of high power prices, good incentives, and good virtual power plant opportunities.
How do you think about what you need to win this market, Jason? Because it's the biggest market at the end of the day. There's a couple other players trying peer-to-peer approaches, often not using crypto, right? What do you really think needs to sort of happen for you to be the overall winner? Is it about getting to local scale? Is it about economies of scale? I'd be kind of curious how you think about the moat here.
I think it's just two very simple things. Can you originate and acquire customers at a structurally lower cost than everybody else in the market? And do you have a differentiated approach to doing that? There is one startup in the market, in my opinion, that it has a differentiated approach to doing that, and it's us. Everybody else is going through the traditional channels of door knockers, basic referral programs, social media ads, things of that nature. So can you structurally create a flywheel that brings people continuously and new originations and new scale continuously into the network? And then can you catalyze a huge amount of capital in order to back all of that? And that is the second very challenging part here. And what we've seen is that model has led to a lot, that second part specifically has led to a lot of collapses and bankruptcies, not because the underlying assets are impaired or defaulting in any way. That's not the case at all. what it is the market for financing for these assets has been really inefficient for a long time. So the Synovas of the world, the Mosaics of the world, these major multi-billion dollar, in some cases publicly traded businesses that have collapsed over the last 2 years have done so because, frankly, just very inefficient financing structures. It's a tale as old as time. You warehouse hundreds of millions or billions of dollars of originations, of loans, of PPAs on your balance sheet, on the corporate balance sheet, or maybe a related corporate entity. You attempt to securitize those in the securitization market, and there's the same 10 buyers of those securitizations. And then interest rates spike incredibly high, faster than anybody expects, because Jay Powell says we're slowing down the money printer, and interest rates go sky high. And all of a sudden, the securitization buyers say, oh, actually, we're not going to buy these this quarter. And we're going to buy them next quarter, or we're going to buy them at a 60% haircut to what you thought you were going to sell them to us for. And now all of a sudden, the corporate issuer has a massive credit crunch, and they collapse. And the underlying assets are fine, but the issuer collapses.
Who's absorbing that?
So there are buyers of these assets, and there's actually just like a lot of people that are really pissed off because they have like half completed solar installations, or they have like a contract with a solar company, so somebody else won't enter a contract with them yet, but like the company is like resolving itself with the bankruptcy courts, so it's kind of a mess. But I think like totally, I was talking to Sal about this maybe yesterday or the day before, Mahesh, a totally underappreciated view on these tokenized yield vault products of scaling capital market activity. Of course, it's like global permissionless access is super exciting. Composability in DeFi is exceptionally exciting. But like an underappreciated part of this is that capital that's locked in a vault is just a giant forward funds commitment to buy these assets at scale. Nobody else has that. Like literally nobody else has that. They have 10 banks that like maybe will buy my securitizations if interest rates don't go up past what they expect. And so there's like that structural risk is totally stripped out of the model because you don't have a warehouse facility sitting in between, or the originator doesn't have the warehouse themselves. It's just purely a relationship between, it's like an Aave pool. There's collateral, which is the infrastructure, and there's deposits, which is the locked up capital, and then those are swapped. And then you get the yield from providing liquidity in that pool. And you totally strip out the risk, which is the middleman in the middle that has to make the loan and then attempt to sell the loan.
The routing of capital is interesting. However, you've seen the stickiness of that capital not be as sticky as perhaps you would have thought. Crypto markets are volatile. Your token may or may, in a scenario where it's ripping, yes, token price goes down, that might influence the stickiness of that TVL. How do you think about that durability of that capital to match the demand that you have and the actual supply of capital? Like, there's levers you can pull in the tokenomics, but how do you think about solving that issue?
Fundamentally, like that is the case for a lot of like bad products. But if you can design a good product that offers something compelling and differentiated and above the cost of capital, like we've seen assets stick. I mean, like Athena is the canonical example, right? Like Athena has not had a hot ball of money TVL rotation game into, Falcon Finance or whatever, like the nth, like Delta neutral stablecoin that's launching, even with incentives. People know and trust the Athena protocol and team. The capital is kind of sticky there because people underwrite the asset as like an actual collateral asset for DeFi. And so that's the North Star playbook for any new yield product in DeFi is like, how do you build trust in the protocol and how do you offer a product that's compelling? We think electricity yields are incredibly compelling and continue to be compelling as this energy demand story and insatiable, demand for electricity continues to play out. And so how do you make sure that the protocol is structured in a way that the rules are transparent, everyone understands what are the risks, what are the opportunities, and then you use incentives to bootstrap initial liquidity. And from there, I think if you build a really robust and healthy ecosystem, you have deep DEX liquidity, you have deep interest rate derivative liquidity in order to manage interest rates. And then last, this is like the most interesting and last piece of the stack that to solve for is like, do you have interesting duration risk instruments? After you solve that, you actually now have very sticky capital. And so big focus of mine has been on solving the duration problem in a longer duration asset. And there's a really cool protocol that's coming to market pretty soon that we'll be doing some cool stuff with that is basically building Pendle for duration risk. And you can build these markets for managing duration risk.
Is that like interest rate swaps or how do you think about duration risk there? Like,
I'm going to kind of butcher the description. So like somebody should definitely go read the Cork docs, but what you can do is a user can deposit a collateral asset. A collateral asset is anything that's sufficiently liquid, right? It could be a stable coin, it could be a yield-bearing stable coin, it could be ETH, it could be STETH, right? But like it is any kind of liquid asset. It's deposited, and just like in Pendle, it mints 2 tokens. It mints a swap token and a principal token. You sell that swap token, and you get an implied interest rate, and that swap token has a duration, just like a YT. And whoever buys that swap token, they have a reference asset. The depositor has to underwrite the reference asset, right? But in this case, it could be S-Grid. And whoever buys that has a reference asset and buys the swap token can now exchange it for the collateral asset at any point of their choosing. So they're getting yield for basically taking on the duration risk. When that swap happens, now the principal depositor gets the underlying asset, and it's up to them to kind of exit through the orderly redemption queues that exist in the primary redemption facility of the base protocol. But what they've gotten is all of the continued yield of the base asset plus the additional yield from selling immediate liquidity. And it's all done through this like really cool permissionless market. And now we have the full stack of building really cool financial products. You have interest rate derivatives, you have duration derivatives, and of course you have a protocol that's like ideally well designed for the asset that they're bringing to the DeFi markets. I think with protocols that do this well and build liquidity in all of these early are the ones that will be sufficiently sticky and have like real moats.
The interesting thing will be to observe the redemption mechanism, because that has always been a challenge. The market is scarred, to say the least, about this redemption mechanics. But I think what's interesting, what you're doing is crypto's always lacked like quality assets on chain. A lot of what has existed in RWA tokenization land is pure, simple, vanilla, treasuries, and that's well understood. Anytime we go above that, like centrifuges of the world, maples of the world have had, I would say you have to trust their underwriting standards. You have to trust, the quality of the asset. But something like solar panel in markets that are well understood, I think if I'm on the side of supplying capital, I would want to understand, I guess what I'm trying to say, the redemption mechanism and also the quality of the underwriting and saying, hey, look, we're going to deploy, these represent solar panels in this particular area. They're well insured if there's like catastrophe risk or whatever. And I would assume in this case, you're giving the front of us, Daylight, are underwriting these in markets where we think are, pretty good and interesting. And it's like, is that the case, or is someone else like?
Yeah, I don't want to interrupt. I also think a big part of it is that like solar loans are a very well understood asset class among like the biggest lenders. And so they almost treat like the loans themselves as being fungible as a result of the securitizations and all of these other vehicle structures that exist. So, versus a lot of the rest of crypto where underwriting matters a lot, the really interesting and unique thing about what Jason's doing is, I mean, if he brings, high yields on chain backed by solar panels, the Apollos of the world, people that like in TradFi, their business model is looking for 15 yields or 15% yields are going to be forced to participate. And I actually think that's the really interesting unlock here, which is that there's all these asset management firms publicly that have pretty much turned into yield manufacturing machines, like the biggest asset managers in the world, Blackstone, Apollo, KKR. They're really just looking for where do we create extreme amounts of outsized yield relative to the risk associated with the loan itself. And like what Jason's creating, I think, is a very unique ecosystem to understand and underwrite these loans, but also access them in a way that's candidly a lot more robust than like traditional solar lending. And the interesting thing is if you have these vault systems, you allow these asset managers to then experiment with pieces of the yield, which allows them to create like altogether new strategies themselves. And I mean, even with interest rates being where they are, like the big asset management machines today are still reaching to get like high yield products that are well underwritten. So I think it's an amazing opportunity to bring a new lender on chain as well.
You all will really appreciate this, but I love nerding out on like just like historical, like weird, like financing mechanisms. And like one of those in energy is something known as the yield co. I don't know if you guys are familiar with yield cos, but they were pretty hot in like the 2010s. And yield cos were, developed by asset developers who wanted to free up capital to go develop more assets. And so they stood up these kind of separate publicly traded entities that could raise equity from public markets, and they could use that equity to buy the infrastructure projects from the developer and give the developer capital, and then the infrastructure goes to the yield co, and it generates yield, which generates like really attractive dividends to the stockholder that, they were pitching a story on, large dividend growth. That model was like super broken for a lot of reasons. Like number one, and first and foremost, is that you're buying a corporate wrapper, not the underlying like infrastructure streams themselves. The other two is they being that the sponsor they have kind of conflicting incentives of how much capital can we get out of the yield co versus balancing the dividend growth of the yield co itself. And so these were all basically like collapsed or were absorbed into private vehicles. And now all of infrastructure is funded basically through giant private infrastructure funds. And no one, and if you're in those private infrastructure funds, great, you get access to this asset class. But people like you and me, and I don't know, maybe Santi can access infrastructure funds, but maybe not. And so like we're all locked out of this asset class now with the absence of yieldcos, which were like admittedly very bad vehicles for doing
They
this.
were
but
crap. You're thinking like
Yeah.
BDC type business development company.
But
type
what I'm
structures,
saying
right?
is our structure, right, Mahesh, is like it is like a total and complete improvement on the yieldco vehicle.
Yeah.
And I was like somewhat inspired by the initial kind of concept of yieldcos for designing the protocol. It actually very much was a giant inspiration behind what we're doing.
I mean, they were a really interesting idea that then just got co-opted by private equity that realized they can use it to offload the assets that weren't going to give them like meaningful multiple expansion in the medium term. And so pretty much you just like created this phenomenon where it was adverse selection and like the shittiest assets would be dumped into these yieldcos, and you hope income seeking public market investors would find them. And it's adverse selection. And I think there's something unique about originating loans transparently on chain for the data for everyone to see. And it's a welcome improvement in private credit world, which I think, as you mentioned, has been becoming more and more opaque over the last 10 years rather than the opposite.
Yeah, it's really like unfortunate that the majority of all this infrastructure is financed through just these giant kind of black box infrastructure funds.
Yeah.
Can you talk a little bit about the pitch to these traditional allocators who participated in the $75 million round, the structure, just commenting on like the appetite out there? I mean, we've been sitting on this chair thinking like expressing a view that DePIN is probably one of the most overlooked sectors in crypto. What was the conversation like with these folks? Who participated? What are some of the key insights you can kind of share with folks?
Yeah, so we had a collection of some of the folks in our cap table participating, and then a private credit platform, the Turtle Hill Capital folks, and really we spoke with a lot of different potential managers and capital providers of this. And what is like exceptionally clear after that process is like there just isn't a lot of capital in this space. Like there still just is not very much capital in the distributed energy space that understands it. Like I said, if you're one of the big guys, you can go to the securitization markets, and there are big buyers of this. But at the subscale, trying to get started, there's not much capital at all. And so, what we found was a partner who thought the model was incredibly unique and compelling, which is, can they access, again, a structurally lower cost origination source? Because that structurally improves yields above and beyond what like typical hurdles are. And then number two, the whole virtual power plant angle of what we're doing. This is very clearly where energy assets and energy markets are going. And we're, I think, really the first financing platform to make the VPP internalize into the financing vehicle itself. And I think that actually improves the durability and the underwriting model, because you're continuing to diversify away purely from the offtake or default risk to like multiple additional yield streams that are coming, from institutional quality counterparties, even though the infrastructure is hosted on a homeowner's house. So that was kind of the broader pitch and how we got people excited about what we're doing. To our earlier point around DeFi markets in general, the advantage of DeFi markets, like it at its core, is just like scale. Like internet capital markets unlock so much scale if you can design an asset that people are excited about and want. My example I use every time is no hedge fund in history has ever scaled from 0 to 16 billion in AUM in like 18 months, and Athena did. Like they were like Bill Ackman didn't do it. Like Citadel, I don't think did it. I don't think anybody got there in 18 months. But scale is available for people that are building really compelling financial products on chain. This negotiation took half a year to get a $60 million project finance facility in place. And that is just like the old legacy financial world. I'm much more interested in just like programming like a financial product as software and launching into the world as code and just telling the world like this is available. And if you're interested, like let's do something cool.
How big are these markets, just to give people some sort of, I mean, I remember being at JP Morgan, we did like Vivint Solar and Solar City, and JP Morgan I think plays a big role in the securitization market for solar panels. Like how big is this market?
Yeah, like I said, I mean, the market itself is big, and the market size, we're talking about many trillions of dollars in the US alone. If you think about deploying distributed energy infrastructure to every home in the US, much less every like commercial building, like put that aside for a second. But every home in the US, you're looking at like $2.8 trillion of infrastructure spend. And so, the size of the market is incredibly large. But, to our earlier point, the securitization market is still like pretty niche, and there's just the biggest players can access it. I don't even think Tesla does securitizations. I think they just keep this all on their balance sheet. And I could be wrong on that, but like that's my understanding is they kind of have maybe some private infrastructure like equity partners, and then the rest goes on their balance sheet. Sunrun securitizes. Sonova used to securitize before they blew up. Mosaic used to securitize before they blew up. But it's still like a niche market, which is why like I think it presents an opportunity for on-chain finance because the assets themselves are very attractive. It's just been a niche market for a long time. And so you kind of avoid what you see with a lot of like traditional like private credit funds trying to tokenize like their assets that are maybe less attractive. Like you avoid the adverse selection problem when you just go to markets that are niche versus markets that are very large and somebody wants to tokenize some weird like shitty part of their portfolio to like offload it on retail, right? Like that is like the wrong method of building new financial primitives. The better part is like, USDAI is a great example. GPU compute markets or lending against GPUs is like a super niche space. And so you kind of avoid a lot of the adverse selection problem. It's just a niche market and nobody's really standardized it yet. And if you take that opportunity, you could build one of the biggest businesses on the planet.
It'd be remiss of me not to mention base power in all this conversation. We talk about Texas, we talk about large new players. Zach Dell, son of Michael Dell, I mean, they've played a huge part in actually started in Austin. They have a huge real estate holdings. They just raised upwards of 200 million, maybe
$1
more
billion.
now, $1 billion. What's your angle and how do you see you guys playing next to them or potentially, cooperating with them?
Yes, they are obviously like a startup that's absolutely killing it. One of the hottest startups in Silicon Valley right now. They're an energy retailer that installs large batteries on all of their customers, homeowners' homes. And they use those batteries as like physical hedges. So they can both generate additional revenues from those underlying batteries by using them as a virtual power plant. They can also improve structurally their margin to deliver the end commodity electrons, kilowatt hours to people's homes by using the batteries as like physical hedges to manage risk and shift consumption to periods where power prices in the market that they're procuring from are lower.
Sounds similar to your model, right?
Yeah, I mean, a lot of us we're doing like very similar things, but I think where we play and where they play will start to diversify as they're really at their core an asset developer. They are a platform that is both manufacturing their batteries and then developing those assets in the grid, on the ground in the grid to provide kind of new sources of structural energy capacity to the grid, where Daylight is sitting much more on the incentive and financing part of the stack. So who knows like where those things intersect. I think like what could be super interesting at some point is they're going to need a lot more financing to scale beyond what's available on their balance sheet. Like that is a great place to go look for additional capital, especially when somebody's aggregating all this capital to deploy into grid edge infrastructure already. So, we'll see. I haven't talked to them about it, but like, this is a giant market with a lot of need for capital. And our goal at Daylight is to incentivize its adoption and improve the adoption rate. And then like make sure we have all the financing capability available in order to deploy it at scale.
So if I'm reading this right, you could use their batteries.
Well, I think like they could use our protocol. Like they could come to the protocol to access financing for their batteries.
Yeah, no, totally. As opposed to raising $1 billion, they could just tap into our capital markets. Your core set of smart contracts and protocol.
Exactly.
That is,
and incentives. And like they could people that are coming to Daylight's network in order to explore what's available to them and how to participate. Like at some point that really kind of opens up and becomes like a new wedge for them to find homeowners that are looking to deploy infrastructure.
that's super interesting.
Yeah, maybe in return, like they allow their batteries to be on the Daylight network, for instance, like kind of.
Well, if they were financed by us, they would be like they would still be the manager of their batteries, right? But like what we're doing is providing capital at an attractive rate of return, and they're getting the infrastructure developed and deployed, and then the rate of return, there's a rate of return coming back to the capital provider, and then excess goes, just like any infrastructure project, excess goes to the developer.
Would you say Daylight has been currently B2C, right? The customer, you have brand, they find your app, they kind of go through the whole flow through the app. How much of this over time you see being B2B2C, like working with other like large players that tap into your protocol, your capital markets, or do you think that most of the value is being a B2C? And maybe that's a mischaracterization on my part, but I'm curious how you see it.
So we're already starting B2B2C right now, where we're offering our financing as a fintech product, basically, to local solar companies in the markets that we're focused on expanding into. And so that does exist. It is like a big growth wedge for what we're doing. I do think, like, again, the biggest opportunity here is scaling capital and then trying to figure out how to change a push market to a pull market. And token incentives are going to be a way we do that. what I think will evolve further down the line is like, do we care if our C Corp is installing the equipment, if some other company is coming in and like buying that customer or buying the right to develop that project and put it on their own network and use our financing and our customer acquisition in order to like build and develop their own assets? Like, I think we'll see all this emerges, but that is kind of where I think it's going, where we're just getting people into the ecosystem using the app. They're doing, rewarding them for conducting a fully AI powered and self-guided energy audit of their home. Nobody has this data on what exists in a home and what's inefficient and what infrastructure should be deployed into that home. And now you have like this repository of, here's a home, it's an interested person. They can now be like, other companies can plug in and like market their product to that customer. And then you have like daily financing there available to finance it on behalf of the developer. And it kind of all comes together in one complete package.
Cool. So it sounds like you guys are crushing. I think just broadly for DePIN, like private markets have been very hot. So October was nearly $160 million raised by 7 companies. But the public markets for DePIN have not been doing as great. And maybe that's a factor that's affected by the broader market. But I'm curious, like, why do you guys think that there's this disconnect between private markets being super hot, everyone's announcing raises, Daylight included, and TGE is not doing as well, broader market prices down? Like, where do you think things go from here?
It's easier to raise a venture fund than it is to raise a liquid fund. And you're in a state of the world where, equity has become a hotter commodity than tokens. You have poly markets of the world that are raising at 15 billion. And I think that strategy is well understood. Like from my conversation with the traditional allocators, they hate the volatility of the space. They hate the token. They'd rather not you sending them an investor update every month with the volatility or every quarter. They say, just honestly, just call me back in 5-10 years and give me a 10x venture-like return. And so I think like Polymarket is just one example where you have a lot of interest in equity, which is kind of at odds because historically, Mahesh, you chime in here, but I mean, it was a bit hard for us to raise for this liquid venture asset class, which is like, yeah, it has venture-like returns, but it's liquid. People just not used to it and don't like it. But now you're seeing some really solid, but historically, again, a lot of the returns has been investing in public, like in infra projects like Ethereum and Solana. That was attractive. Now you have this more interest from traditional allocators, and they're going to express that view through equity and private markets. And so on a relative scale, there's way more capital chasing private venture equity instruments than tokens. So it's just a challenging piece. And it's not just DePIN. Like, look at pretty much every major project that has TGE'd over the last 6 months. I think most of them are down from where they listed.
Yeah, no, I think Santi hit the nail on the head. I think a big part of it is just like with equity, you know what you're getting. There's a contract, there are rights. With tokens, you just have no idea. And, you might get an amazing business where the founder gives the value to the equity or to the token. You might have someone that just runs away and you never hear from them again. And so I think people are pricing structural risks into liquid tokens in a way where they just don't know how to underwrite it. So they're creating a discount. I used to joke in 2021 to 2022, like tokens traded at a premium to the equity market because they were just easier, they were faster, they didn't require as much effort to understand. And I think now there's so many people that have been burned that have bought a token that didn't give them what they said it would give them, that there's just like a significant lack of trust in the token market, which has made it almost impossible for liquid managers to raise a ton of capital. And so that's just kind of what's played out over time. There's still a ton of capital being raised for venture, which means there's a lot of money to fund these kinds of ideas at the private market stage. But, at the liquid market stage, how many billion-dollar liquid funds are there still in crypto? I guess you probably count them on one hand. Versus no, okay, maybe there's more than I know about, but the ones that are bidding altcoins and the ones that are able to bid like the smaller stuff, like the Heliums of the world, there just doesn't seem like there's that much capital for it today, on the basis of one, how returns have gone, and then two, like what LPs are willing to fund.
I mean, I'm just looking at CoinGecko's categories. DePIN market cap, not fully diluted, but current market cap is 13 billion. That's a fourth of Hyperliquid. And it reminds me a lot of where DeFi was back in 2020, where you could have pointed and said collectively the entirety of DeFi was like a fraction of Dogecoin's market cap, or Ripple's market cap. And so, I think that is a ratio to track. If I were to go long, hopefully, we would have done something terribly wrong as an industry if the ratio of DePIN and DeFi as a whole of what of the market cap of like all of layer ones excluding Bitcoin, that should go up dramatically. Because right now it's less than 1%, right? Or less than 2%. That has to change, because if that doesn't change in 5 years for both DeFi and DePIN, that would have meant that we didn't really graduate as an asset class from pure speculative activity. And the problem with speculation is A16Z put out a great report. There's only 40 million active users in crypto today. And yeah, the casino use case is very strong, but you have two problems with that. One, you churned through that user base constantly because people get liquidated every month. And so you never really grow. You cover a lot of users, but you don't really grow. And the second piece is, you can't really justify the valuations, right? And so from a fee generation standpoint, a lot of that speculation activity happens in exchanges in their omnibus accounts. So you're actually not settling on chain, and that doesn't produce cash flow and fees. And so I think that's the figure to track. It's like 13 billion for DePIN. If that doesn't grow 10x in 5 years, I think we're in a tough spot as an industry.
Yeah, I think the one bright spot in DePIN publicly traded tokens at the moment is Helium. So I kind of had an inkling, but I went and looked at the actual data, and since they announced 30K a day of buy pressure from the Helium mobile revenue, Helium's up 24% and Bitcoin's down 4% since then. So maybe there's like a decoupling that can happen, even if we slide into a bear market here, in terms of like, the projects that are actually buying back their token and burning it and finally accruing revenue and finally becoming deflationary. Like maybe there's a way for DePINs to kind of like escape out the rabbit hole before it closes in terms of speculative capital.
I mean, if the market's rational, you could see, like, if the Helium MVNO continues to grow from like 1 million users to like 5-10 million, it becomes one of the largest MVNOs in the US. Like that has a valuation implication. Now the question is how much of that value translates back to the Helium network. I don't have a perfect answer, and that this is perhaps a topic for a later date, but could there be a dislocation? And there always has been, like, between the equity and the token, but I think if you do this well, it should translate too. But again, like infrastructure, I think where perhaps the market's not entirely dumb. I think it has concerns around this dislocation of equity and token, but also a large part of what DePIN is doing, in my estimation, is just lowering the cost of infrastructure in otherwise capital-intensive industries. And so to say that the value that will be translated from traditional infra to DePIN, I think is something that may or may not happen. The question is how much, right? For every dollar that has been invested in infrastructure, how much of that value capture will happen in DePIN? Because and who's going to capture that? Maybe whoever captures that is the end consumer, not so much the DePIN protocol, like a GeoNet or a Helium or a Hive Mapper. Maybe the greatest benefactor here might be the end consumer.
Yeah, it comes down to, do those DePINs have pricing power and can generate positive margins and all of that, while still delivering a superior end product to the customer. But I mean, I will say, like, over the past maybe 4 months, we've seen Helium go from completely separate equity and token to like slowly not actually merging them, but merging them kind of like financially, right? Like at first they were just burning tokens out of their treasury for Helium mobile revenue. Now they're buying back every day on the open market and burning. So they've really like come a long way in terms of financially kind of merging the equity and the token and driving value to the token. So it's been really interesting to see. And I hope there's a continued dislocation between H&T and the broader market, because it's trading at like a 15 to 20x multiple in terms of not even revenue, like buybacks versus market cap. And so that's like, like a similar to a PE ratio or something anyone else could understand as like a way to value the business. And it actually seems like kind of undervalued if you think about the growth potential here.
Yeah, what is the NASDAQ like, or S&P like, average price to earnings?
20 to it covers between 16 to 25.
It's that high right now?
It's 23 to 25 times.
Yeah, I mean, on earnings, right?
Yeah. It's 28 on Mag 7. It's 18 on everything else.
It's insane that a company that's growing as fast as Helium in terms of like subscriber growth and offload growth is priced at a discount to that multiple.
That's I think the biggest wake up that the market again hasn't really realized, which is this is not your typical shitcoin. It is backed by like actual activity in a company that is called an MVNO, and you can point to a public comp of an MVNO, and the market should be rational, and there's a big disconnect. But yeah, I mean, you're right. Like Helium is up 10% year to date, which has outperformed something like Ethereum, I believe. Ethereum, I think, is flat on the year.
I think it's flatter down. Yeah, which is crazy.
It's flat. But yeah, I mean, Helium market cap network is $500 million, 533 million. If what would be interesting is as the MVNO continues to scale users, active users, I could tell you there's probably some MVNOs in the US that have similar or slightly more users that don't trade that too dissimilar. So at one point, it's just going to be a very big discount, right? But I think the market just is slow to react to these things.
I mean, the other thing is they're about to break into the top 10 in terms of Solana apps by revenue. So I don't know if you guys can see this, but basically it's Pump,
cool.
Jupiter, Axiom, like they're number 12 daily, weekly, monthly.
They're the only one that's decoupled from crypto market revenue.
Exactly. Yeah, and they're the only kind of like non-DeFi, non-trading, non-token launchpad kind of project. So I'm excited to see this trend continue, and hopefully they start to get more attention as they get into the top 8, top 6. I mean, that's when it becomes like, I think, very widely known what they're up to. So will be good to track here.
Actually, yeah, I think there's like, to like top it off, I think like the biggest discount factor, there's like a lot of, I think like liquid funds that are allowed on Twitter that basically just like want like tokens to just be like equity with all like the legal and like enforcement of them. I don't think that's the case. Like even the market structure bill doesn't even contemplate that. It's like, I don't think that's going to happen. But what I do think is that enforceable on-chain revenue is worth multiples more than revenue that exists off-chain that the team promises will pay it back. So like who controls the administrative rights to the value flows. And the cool thing about what we're seeing with like Duna structures, with like the MetaDAO, like experiment, like all these things are kind of pointing towards if like governance really and truly controls the key, like the admin rights to the revenue flows, I think that is where we're going to see the real multiple separation. That's just like a thesis that I have. If it's like the team promising to not change the revenue flows from the token to their equity, there's going to be a big discount for that. If they literally cannot change the revenue flows, then there will be less of a discount. So I actually think it's like a more nuanced conversation than like, are they buying back the token or are they not? It's like, can they stop buying back the token if like the core team decides to?
We should debate buybacks in one of these pods. That would be a good episode.
Buybacks versus burns versus whatever else.
Versus growing.
Reinvestment, yeah.
Well, I think it's a good place to leave it unless anyone else has anything. But exciting stuff. Jason, great to hear about all the progress, and we're still championing our favorite DePIN, Helium, who's making some good progress in the public market space. So guys, thanks for coming on, and we'll talk soon.